All right, so if you are a mutual fund investor or willing to be one, you have to master the art of timing your investments. Since mutual funds primarily rely on equity stocks or debt instruments, knowing when to invest in as important is as knowing where to invest. So we are actually talking about new fund offers over here, and what do you think? How do you understand NFOs, and what should you be keeping in mind when you want to invest in an NFO? Should this be an investment option for you at all? We have Mrin Agarwal, founder director of Finsafe, with us to talk more on this. Mrin, hi, good evening, and welcome to the show. Not as many as in numbers that we saw last time coming. We have a few NFOs that been launched recently, but very interesting ones. Before I get into the do's and don'ts and the criteria based on which you should be deciding to invest in NFO or not, let's talk about the new launches. I want to start with HDFC Defense Fund, which sounds very unique and very different, in terms of being a sector or a thematic fund. How would you explain what's the structure of this fund?
So good evening, and thank you for having me on the show, Kavita. Well, this is a fund that invests in defense and allied sectors. Basically, from what I saw in the presentation, it's a small subset of stocks and mainly PSU-oriented stocks, basically. So it is a extremely high-risk sectoral fund that basically is riding upon the theme of defense spending, Atmanirbhar Bharat, and the fact and the big focus that's there on defense in India. So that's what the fund is all about.
All right. We will talk about the risk factors and the decision to invest in it or not later on. But then going ahead, the second name on the list is BNP Value Fund.
Yeah, so it's a fund that basically looks at the value style of investing, looks at stocks which are undervalued at this point in time and which could have a growth potential in the future. So just like many other value funds, this is another offering in that space.
Next is a business cycle fund from Quant AMC. Now, that's the NFO that's people are really excited about, and especially the kind of return Quants fund have given in the past. Being a small AMC, few of categories have been really hit in investors. What about Quant Business Cycle Fund?
So essentially, business cycle funds have been again around for more than 10 years. There's a limited number of funds in this space. So typically what these funds try to do is try to look at different business cycles and try to catch the cycle at the beginning of the cycle and try to do allocations based upon how they see the business cycle basically playing out, right? What I find in these funds is that the business cycle funds, if you look at the existing funds that are there, haven't had that great a performance, or let me say outperformance over the bench over a simple Nifty 50. And these funds tend to also be having very high expense ratios compared to more broad-based funds. And again, the fact remains that any fund today would be looking at a business cycle before making the next bet. So I don't really find anything so unique about any of these funds that we've actually listed down. I mean, if you look at the value category, that also already exists. Of course, the defense fund is something that's different, and for people who do have an idea about the sector and want to take a concentrated exposure, it's a good bet.
UTI Housing Index Fund. Now that sounds something new.
Yeah, that sounds something new again, going on the whole housing space basically. But Kavita, honestly, like the issue with all of these funds, except for the Nifty 50 equal weighted fund, all of these funds tend to be thematic or sectoral in nature, and again, these come with their own
concern because
disadvantages.
which is the point in concern, Brin, because till last year what we were seeing a lot of passive funds being launched. We did see a few innovative themes coming up from AMCs, but this time it's more thematic and sector oriented fund. So first of all, investing in an NFO where there is no track record of a fund, even if it's coming out from an AMC that's been in the business since ages, the fund is new. You don't know how are they going to manage. You don't know the kind of conditions going ahead for the fund unless and until it's like a pure large cap or a mid cap or a known category that you can track of, because you have a basic understanding as an investor. But these are thematic and sector funds. One really needs to have a co-portfolio in place before they want to diversify in something like this. Now, talking about HDFC Defense Fund, it sounds very kick-ass so far, okay? But then you need to have the risk appetite. You need to have an understanding of this particular sector, which gets me to the question, how do you get a sector understanding, and what should be that stage when you should be investing in an NFO which is so concentrated?
So, firstly, I agree with you that these are all tactical allocation funds. These are not your core allocation funds, right? And, with tactical allocation, now you could keep aside an amount, let's say 10 to 15% of your equity portfolio for tactical allocation. But then you need to be very clear about where you want to tactically allocate this. I mean, what are the sort of sectors or what are the sort of themes? And, the other thing with a lot of tactical allocation is that while we always tell people not to time the markets, this is something in which you do need to have a clear strategy for entry and exit. Now, I also find that a lot of NFOs actually come when, there has been a significant run up in the stocks as well. So people who are investing into this need to be mindful of that fact as well. I mean, we've seen a good run up in PSU stocks, right? So people need to be mindful of the fact that they're entering after after there's already been a good amount of run up. And with any NFO, as you said, there's no track record. You don't know if the theme is really going to play out. Look at the whole pharmaceutical theme or the healthcare theme, which was so big in 2020, right? But 2021, 2022, healthcare stocks have been right at the bottom, right? So the main thing is that if you are planning to do a tactical allocation, you need to be very clear about what sector you want to do it in, and it has to tie in with your risk profile and your investment strategy. A lot of investors get into it thinking it's something different, something new, let's just try it out. I don't think that you can have that sort of a stance to say, let's just try it out, because, when you try it out, you're putting some small amount. It's really not even going to make a big difference, even if it works out really well, right? Also, you must remember any NFO, any sector fund comes with much higher costs, right? Than an index fund, or let's say than a broad-based flexi cap fund that has been around for years. And, so you need to be mindful of the costs as well.
All right. One fund I want to really, because I think a value fund is something that's a category that's really known to investors. And when we talk about BNP value fund, so far, any point that makes it or that differentiates it from the existing lot in the category?
Not something that comes to my mind, honestly.
Mm-hmm. 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 So if one wants to have something where you can have a value strategy, there are already funds in the category which can be recommended and which can be looked at?
Yes, that's what I would say. I mean, see, I know that, past performance may not be emulated in the future, but I would always go with a fund that already has a past track record that you can look at, and that will be lower cost as well, over, trying to look at an NFO.
Now, instead of having a tactical allocation, first of all, how important is a tactical allocation? And even if we talk about tactical allocation, should an NFO be an option for that, that part of diversifying your portfolio?
So I don't think that, tactical allocation is absolutely necessary for everybody. In fact, it's mainly for advanced investors, suave investors, who are wanting to manage their portfolios actively. They can look at a tactical allocation. I mean, to be honest with you, for a majority of investors, I think, their focus really needs to be on the core portfolio, looking at getting the core portfolio right before really looking at taking these sort of bets. So that's the question on the tactical allocation. And the second part being, do I use an NFO for tactical allocation? Well, if you understand this sector and you believe that this sector is going to have good performance, and you have a good amount of knowledge in this particular sector, and you want to take a concentrated bet, then I think it's fine to look at doing the NFO. But don't just do it because it's available at 10 rupees or because it's something new that's come out right now.
One more thing, the point that you and I are discussing, I mean, I'm sure it must be considered by these AMCs also who've launched these kind of funds, right? So what's actually driving them to launch sector or thematic funds?
I don't know. I mean, probably they have some data that shows them that investors want this, or it could just be to increase their product portfolio. I really don't know, but I think, again, for a majority of investors, I don't think that they should look at these funds, because in any case, the high conviction bets from any of these themes or sectors would be there in the broad-based funds as well.
All right. So just because the theme or the sector looks very fancy doesn't mean that you need to have it in your portfolio and you need to put your money into it. The kind of NFOs that we just spoke about, anything that's already existing in these categories where one can look at, anything that you can recommend?
Well, the equal weighted index funds, I think, have been around for the last couple of years. And business cycle funds have also been there. Value funds are also there. I mean, honestly, Kavita, I would actually just recommend that do an index fund like a Nifty 50, or look at doing a flexi cap fund. My favorite always still remains Parag Parikh itself, or Kotak. I would just say that, if you want all of these themes and you want all of these sectors, you can actually just get them in a nice flexi cap fund, which is much lower cost simply because of the size. And you don't need to go and take, it's well diversified as well, so you don't need to take these concentrated bets. So I would just say that instead of doing all of this, just go and invest in a simple flexi cap fund.
All right, so that's all about NFO. I think we've discussed quite in detail about when and how you should be investing in NFO and why should you avoid it if at all you should. But then let's move on to our other topic, which is managing your expenses. Now, Mrin, a lot of time what happens is people assume that investment journey means you need to have a large corpus, first of all, in your hand, so that you can invest that money. Okay, and a lot of time people feel that they have missed the bus because they do not have enough money to put in the market or anywhere, in fact, to invest. A lot of time people don't do the right kind of budgeting, where they don't know how much can they save, and accordingly, if there is no saving, there is no investment. What I really want you to help our viewers with right now is how can you actually figure out your savings amount which can turn into investment, and how little is needed to start that investment journey that you've been dreaming about since years.
And this is the most important part of it. So you could be earning whatever you are, but finally it's about, how much you're saving and how much you're investing. So it doesn't really matter what your earnings are. And this is a very common question that I get, that I'm not able to save. And even honestly, we've done some surveys and we found that most people actually save less than 15% of their take home, right? And that's a very, very low number. If you really want to build wealth, right? So in order to build wealth, what is important is not only to earn well, but more important, it is to save well and invest well. So how can you really start saving more, right? And I think the only way to do it is by following some sort of budgeting rule. Now, there are two ways to do it. One, you could follow a rule, and what I recommend is 30-30-40, which is 30% expenses, 30% EMIs, and 40% savings. Or if you find it very difficult to stick to these sort of numbers, then you could say, okay, whenever my income comes in, first I push out whatever I need for my expenses and whatever I need for my investments. And then what I have left over is actually what I can actually spend on my lifestyle expenses, right? So there are two ways to really do this. I think, just like in physical fitness, where you have a goal to reach a desired weight, you first of all need to start by saying that I want to try and save at least 40% of my take home. So if you are at 15% today, I think your immediate goal should be looking at bumping it up to 25% and then looking at taking it up further, right? Another thing that really helps is to automate investments. So before you can spend that money, push it out into investments, and that really, really helps. Today, lifestyle investments are a very, very big part of the total expenses. And I think it's good to basically make a list of these lifestyle expenses and see, where is it that you're spending and what is it that you can really cut down. Now, even within the 30-30-40, where I said 30% is for expenses, I would say, break that down further and say, okay, I'll keep 10% of my overall income for lifestyle expenses or 15% for lifestyle expenses, right? So have a limit and stay within that limit. And it's akin to your physical fitness where, you're not going to go beyond a point on, and you're going to ensure that you stick within the limits, right? Now, again, a lot of people face this issue where they don't have much left after expenses. So what can you do at this point in time? First of all, make a list of all the expenses and create a tracker in a simple paper or an Excel spreadsheet and mark out, what is it that you can cut down? It's again, like what can you cut down in your food to make yourself more fit? Or what are the things that you can cut down, for your own wellness, right? It's the same thing with your financial wellness as well. Of course, you'll have to go on a spending detox as well. So if it means removing apps from your phone, if it means not getting out on the weekends, whatever it is, you will have to figure out what is that spending detox that you want to have in order to save more money. I mean, finally, it lies in your hands, right? I mean, you cannot increase your income, but you can reduce your expenses. So that's what you really have to focus on. The other aspect is also that if you are not investing not saving too much and hence not investing too much, then one of the other things that you also need to do is look at maybe taking a slightly higher amount of risk in your investments to make up.
All right. Also, what's that minimum amount with which you can start your investments?
Well, you can start investing with 500,000 rupees in mutual funds or even with PPF or NPS. The minimum amounts are like really low. But, I would always, instead of going by the minimum amount, I would say that, track it as a percentage because that's what, will then help you have a goal to work towards.
That was a question so that people don't have any excuse saying that they don't have any money left, end of the month or beginning of the month, and it's just 500 rupees or maybe even 100 rupees, if it's an SIP that you want to start. All right, Mrin, thank you so much for being on the show and helping our viewers with various aspects of financial planning today. We move on, and we at the Times Network are back with our flagship event, India Economic Conclave, which is known to set the stage for driving India's economic agenda as we move forward on the path of integrated, equitable development, which is all inclusive, pervasive, universal, and one that strengthens not just the Indian economy but the global one as well. To pursue this agenda, the theme for this year is India, the emerging third superpower. IEC will feature the biggest voices from politics, global markets, economy and corporate world. So get ready to catch all the action here on Times Network. Welcome back. You're watching The Money Show with me, Kavita Thapliyal. Starting a mutual fund for your child no longer requires the cumbersome process of opening a bank account in their name. Now, according to a recent circular released by Sebi on May 12, 2023, investments can now also be made from the bank account of the parent. Now, this new rule will be effective from 15th June 2023. What will the new rules mean and how will it affect you? Let's understand all of this with Aditya Agarwala, Head of Research and Investments, Invest4edu. Aditya, good evening and welcome to the show. Let's decode this circular. So far, what's the pattern of investment for your child if you want to adopt the mutual fund route, and what has changed in the circular?
Good evening, Kavita, and thanks for having the show. So clearly, let's first get into what the previous circular was. So in December of 2019, SEBI came out with a circular which made it mandated that every investment in the name of the minor could only be accepted from the minor's bank account or a joint account with a guardian. So far, the circular said that if you want to open a mutual fund account in the name of the minor, you had to have a minor's account, bank account, or a joint account in the name of the minor and the parent. Now, after taking into consideration the recommendations of the Mutual Fund Advisory Committee, SEBI recently came out with an amended circular on 12th of May 2023, which no longer makes it necessary to go through the cumbersome process, as you mentioned, of opening a bank account in the name of the child to start a mutual fund. Now, as per the latest circular, which comes into force from 15th of June 2023, if the parent has a bank account or the legal guardian has a bank account, they can start a mutual fund in the name of the child, which is a very welcome move because the parent doesn't have to go through the process of opening the bank account of the child, and b, it makes the investment also very easier, and to track the investment also becomes easier. So the new circular which the SEBI has come out with is a welcome move, and should help and motivate parents to invest more in the name of the child.
Aditya, it definitely makes it easier to start investments for your child. But then I want to understand, why was the process so cumbersome? And also, when you're investing through your child's account or a minor's account, there is some sense of commitment. You know the goal, and the goal is the future and the better future of your child. That somewhere with this new circular gets diluted. What do you think?
There are two sides to the coin, Kavita, to be honest. I don't think so. If a committed, see, child education goal is a very important goal. Every parent should have a child education goal. And if you don't have an education goal, you don't know exactly how much you are incurring. So every parent should have a dedicated saving fund, which they should identify the exact cost of education, and then they should have a dedicated education goal. And if you have a dedicated education goal, definitely you will want to invest. In fact, I would say this circular makes it easier for the parent to open a mutual fund account and start saving for in the name of the minor. Because we all know, if you want to open a bank account in the name of the minor, there are several documents you have to procure, and then go to a bank and open a bank account, or even if it's online these days, which no parent would want to do. And most of the parents will have a bank account, and it becomes very easier for you to then open a mutual fund account in the name of your minor and start your savings. In fact, if you start a savings, I believe in the minor's account, in the minor's name, you would want to continue with that rather than just redeem in case of emergencies, and there will be lesser withdrawals if you actually have a dedicated a mutual fund account or an investment in the name of the minor, which is dedicated for his or her education in the longer term.
Right. So, just to understand that if I've got this right, so for example, you are already doing an investment for your child, or maybe you want to start investing. This can be done through your existing bank account. You do not need to have a new bank account for a fresh investment.
As far as investment is concerned, yes, Kavita, you don't need a fresh bank account in the name of the minor, or you don't have to open a fresh bank account yourself. If you have an existing bank account, if the legal guardian has an existing bank account, if you have a joint account with the minor and the parent, you can start investment in the name of the minor. So, which is why I said this is a very welcome move, because it makes the process much easier, much smoother, and much faster. Today, if you decide to open an investment account in the name of the minor, you just have to complete the KYC process and you start investment immediately. Whereas if you have to open a bank account first in the name of the minor and then start investment, it becomes a bit of a cumbersome process and a long process. This is as far as investment is concerned, Kavita. But the moment you talk about redemption of the same, then you have to have a bank account in the name of the minor, and the bank account should have all the KYC process completed, and the money gets transferred into the bank account of the minor, not in the account of the parent, which is very important for the commitment of this fund to continue, and make sure that the goal for which you were saving is eventually met.
Anything that you need to intimate to the fund house?
No, I believe they should come up with more and more plans for children, because honestly, this is one area which is not clearly looked upon, Kavita, and we all know child education inflation. In fact, in child education is rising at an alarming pace. 10 to 12% is the basic inflation. It is the education inflation, which is way higher than general inflation. So I would strongly urge all the fund houses to come up with more plans dedicated for child education investments. There are a few, to name them, UTI, ICICI, HDFC have a dedicated child investment plan, but they should promote it more, and maybe more and more AMCs should participate in the same.
Asking you more about these plans, but then before that, I want to understand the taxability of such investment. Now, if you want to withdraw the money before the child gets 18 years old, what will be the taxation or the tax implemented, and post 18, what will the tax liability?
Important topic to cover as well, as far as taxability is concerned. So if the child is still a minor, hasn't turned 18, and if you redeem the funds, then it is taxable in the hands of the parents. And if the investment is redeemed after the age of 18, then it is a tax in the hands of the children, because clearly the funds is now transferred to the child after the child turns a major from a minor, and taxability then lies in the hands of the child, not the parent.
This entire process of transferring, now when the child gets 18 and above, how do you transfer this entire ownership to the child then?
It's not a very cumbersome process, Kavita. It is very easy, because you are saving for the child, and there's a dedicated fund for which you are saving. So the moment child turns 18, you have a bank account for the child, which eventually you will open, because the money is eventually, post redemption, is going to get transferred in the child's account. So it is not a very cumbersome process. It is very easy. The funds get transferred in the child's name. It is in the child's name. The funds get deposited in the child's bank account, and once he or she turns major, they just have to pay a tax, which is your capital gains tax post redemption.
What about KYC? I mean, post 18, if the account becomes a major account, then you'll have to do a fresh KYC.
Oh yes, as you do in case of all the bank accounts, the formalities, you will have to have that in place. If it's already done before, then you don't need to go through a fresh process of KYC. That will suffice.
We are just talking about mutual funds over here, right? And all category of mutual funds where you're investing, not the specific child plans, or is it just specific child plans?
No, in fact, if you want to, this is specific to child plans which are there. If you want to invest in those child plans, then these are the regulations which are there. You can invest in other mutual funds as well, Kavita, in the name of your in the name of the minor. You don't need to specifically invest in child plan if you want to invest in the name of the minor. So there are a whole host of funds which are available depending on the timeline that you have. That is very important to identify which investment plan, which fund you are opting for. That plays the key role here. And you can go for a dedicated child plan. You can make a mix of dedicated child plan and some of the funds which are available, which are not dedicated child plans.
Let's talk about the options available when you want to select a child plan. First of all, is it the right strategy to opt for a child plan, or maybe just a mutual fund or equity investment can take care of your child education goal or anything related to your child?
If you opt for a child plan, obviously there are certain advantages to it, because they are taking care of the fact that it is dedicated for child's education needs. And when it comes to child education needs, you don't want to play very risky there. You want to play but it's safe. Make sure that you're getting decent returns, and your goal is eventually met. That is more important. But if you are savvy, and if you have a bit of a knowledge about equities and investments, then you can opt, like I said, for a regular mutual fund as well. It will all depend on the timeline. To give you an example, if your child is less than 8 years, or maybe an 8-year-old child, and you have your 10 years or beyond in your hands, what you can do is you can opt for a slightly more riskier plans, which is a mix of a flexi cap, a mid cap, a small cap, and a large cap, and you can bundle it up with a child plan as well. While if your child is already 13 to 15 years old, then you can't take that kind of a risk, Kavita. Then you can have to opt for a child plan which is investing predominantly into debt, like an UTI fund, which invests 80% into debt, because you don't have that kind of a time, and you can't take that kind of a risk as well. So it all depend on the timeline that you have, and the earlier you start, the better it is, because the options are more available for you, as I mentioned, and the higher the returns you get.
Aditya, the child plans that you are recommending, what's the kind of exposure and investment strategy that they follow?
So they like I mentioned, they adopt a very simple and a goal-based strategy. If we talk about ICICI Pru, they have a mix of 50-50, 50% debt, a 50% equity. If I talk of UTI, there too you have a good balance of 60-40, 60% into debt, 40% into equities. Again, if I talk of SBI, ICICI, they too, HDFC, they too follow a similar kind of a pattern. So being a dedicated child plan, they have a good mix of debt and equity, because you don't want to take that kind of a risk with your child.
Aditya, what's the return been like? ICICI Pru Childcare, Access Children Gift and HDFC Children Gift Plan.
So all give you similar kind of returns, Kavita, in the range of 11 to 12%. On the upside, it goes as, I guess, 13%. On the downside, it is 10%. So it gives you similar kind of return, 10 to 13%. And if you want to include mutual funds which are not dedicated child plans, then you can look at slightly higher returns. But as far as child dedicated mutual fund plans are concerned, they give you a return of around 10 to 11% on an average. CAGR returns I'm talking about here.
All right, Aditya, I think we've covered all the aspect of this important circular and the way ahead for parents who want to strategize their child financial planning goal. Thank you so much for being on the show today. And with
Pleasure,
that, we'll take a quick break. Post that, let's get Anand Ladha online and let's get your financial portfolio queries answered by him. Welcome back. You're watching The Money Show with me, Kavita Thapliyal. There are plethora of funds available in the market to invest your hard-earned money, but how do you assess which is the right fund for your portfolio? What are the criteria that one should look at? To help you navigate through this maze, we have on board Anand Ladha, founder Invest4edu. Also, do not forget to send us your portfolio queries on our WhatsApp number, which is 865-797-4571. You can also email us your queries on themoneyshow@etnow.tv. Anand, good evening and welcome to the show. Let's begin with our first viewer, who is Surinder Singh, and he's 45 years old from Punjab. He's invested 1,000 rupees in Access Growth Opportunity, Canara Robeco Small Cap, Canara Robeco Blue Chip, and he wants to know if these funds are good for him. Details are not enough. We really need to know his entire purpose of having this portfolio. But then before I ask you, let's just talk about the returns and the performance of these funds. Access Growth Opportunity, what kind of a fund it is, and maybe last 5 or 3 years return, what's been the strategy of this particular fund, and how is it performing?
Hi, firstly, good evening, and thank you so much for having me on the show. If we talk about this particular portfolio is decent. Last 3 years return of Access Growth Opportunity Fund is roughly around 27% if we take it out on a whole. And if we talk about CAGR returns, then also it is comfortable. It's a moderate to aggressive kind of fund. Our main focus in this fund is that we are getting exposure to both large cap and mid cap stocks. So it is a properly good diversified portfolio. If we talk about this particular person, Surinder sir, I think right now he's investing 3,000 rupees per month. The only issue which I am seeing in his portfolio is that even if he is investing for next 20 years, he will be able to get a corpus of roughly around 30 lakh rupees at an expected rate of return of 12%. If we want to increase his corpus, because I think he will be requiring a bigger corpus, we don't have the exact details, but still if we are targeting a bigger corpus, he will need to have step up SIP, or he will eventually have to increase his SIP as and when possible. If we talk about funds are decent. Canara Robo Small Cap Fund of lately has been one of the favorite fund. It has been a 5-star rated fund performing superbly well. And finally, if we talk about blue chip fund, instead of blue chip fund, he can directly invest in index, because going forward, it will be really difficult for blue chip funds to beat the benchmark, looking at past performance and past data which we have. So I think this is one small change which he can make, that instead of Robeco blue chip fund, he can add a direct Nifty 50 equal weight index fund of any fund house which he likes, and he can probably focus on increasing his SIP eventually.
You say that it's going to be difficult for active blue chip funds to outperform the benchmark?
Because of even if we see past data, we see that a lot of rather majority of the blue chip fund are not able to beat the benchmark or the index. Uh, there are two major reasons which we can see. First is the basket is very limited. You have to choose from very selected stock, and in that squeezed basket, it is very difficult to outperform. Plus, at times we see that stock which are heavy weighted in index, for example, Reliance, if that stock outperforms heavily, then it is very difficult, because any which ways, because of restrictions which mutual fund house cannot invest above a particular limit in a particular stock. So they are bound to follow that rule, and they are not able to invest in a particular stock, even if they feel that this particular stock or this particular theme can perform too well. So this is the limitation which we have. So considering the past performances of all the blue chip fund, consensus is that we should focus on index fund instead of investing in blue chip fund.
All right, going ahead, Surinder wants to add any other category fund in his portfolio, maybe increase the investment. Should he be doing in the existing funds that you've recommended, or he can actually add one more fund to his portfolio?
The existing portfolio is decent for a moderate to average risk investor. Only thing which is missing from his portfolio is a debt component or a debt fund. If not debt, at least balance advantage fund. I hope that he's taking care of the debt part by investing in FDs or some sort of debt instrument. So that is missing from his portfolio. Otherwise, I think it is a stable portfolio and a moderate to average risk portfolio.
Anand, we move on. We have Dr. Sridhar's question. He's 35 years old and he has a term plan of 1 crore till the age of 85. He also has a health insurance plan, 10 lakh coverage, and the mutual fund investments are into ICICI Sensex Fund. He's putting up 5,000 SIP there, Kotak Emerging Equity, 5,000 SIP, Axis Small Cap Fund, 5,000 SIP, Canara Tax Saver Fund, 5,000, and in total, I think it's 20,000 investment per month that he's doing. And it's a retirement goal for which he's investing, and the time horizon for this goal is 25 years, but we still don't have the entire corpus that he wants to accumulate through this portfolio. Okay, first, I think the term plan is fine. He might want to increase it if there is more financial liability on him. What do you think? Maybe if he has a home loan on him that he might want to cover in his term plan coverage?
Surely he can do that, and he can top it up in his existing plan. That is absolutely okay. And I hope he has taken accidental rider, because majority time, if something happens to any human being till the age of 50, it is because of an accident. So accident rider can be added in a term plan. I hope that it is already taken care of, and if it is not, then it is to be taken care of.
And even a critical illness plan will be needed, like a cancer care plan and the other specific disease plans that one needs to take?
Yeah, that is see, 2 riders are very good, and we should always take riders with term insurance, because term insurance premium is always fixed. If we add any rider with health insurance, premium of health insurance keep on increasing as our age increase. So it is always good to have all the riders added with your term plan. Critical illness and accidental rider are 2 riders which are actually good and should be added. And since he have a 10 lakh insurance cover, he should ensure that a lot of companies, for example SDFC, give some cashback on submission of regular bills. So he need to ensure that he's taking that cashback. Roughly, it is somewhere around 5,000 rupees per annum, and a lot of people don't know about it. So this is something which he can take care of. This will give him some extra bucks.
To have no idea as to what health insurance plan he has, and also if it is an individual plan or it's a family floater, so no information over there. But then let's quickly get on to his funds. He has an ELSS, a small cap, an index fund. How do you see the mix?
See, before talking about mix, let us talk about the corpus. He can be targeting a corpus of 3 to 3.4 crores. And if we take 6% inflation in mind, then if his present expenditure is somewhere around 43 to 45,000, it will be taken care of by this expenditure and by this investment which he is doing. So he just need to see that is his present expenditure in the range of 43 to 45,000. If yes, then he is good to go. If we talk about funds, fund mix is good, actually good. I think he has already taken an index fund. He's investing in emerging equity fund. He has a small cap fund, and at the same time he has a tax saver fund which is taking care of his ATC reduction. So it's a good mix of fund. There is no need to make a lot of changes or a lot of up and down in his portfolio. Debt is missing again, and I think that he is taking care of this debt part by investing in FDs. I am assuming that part. If not, then he need to add a balanced advantage fund in his portfolio so that debt equity mix is proper. And by chance, if there is any correction in the market, he is not maybe he's not nervous by that volatility, and he will be able to ride that volatility properly if he has proper debt in his portfolio.
How much corpus did you say? 3 to 4 crores?
Roughly 3.2 to 3.4 crores.
All right. We really don't have any breakup of the goal that he has aligned. It's just a retirement goal. So we are assuming that this figure looks good to him. But in case if he wants a higher figure, definitely he needs to add more investment, right? And no more funds needed?
Just a BAF if we don't have any debt instrument. Otherwise, we need not do a lot of thing with the portfolio, because he has a small cap, he has a mid cap, he has large cap index fund. So everything is taken care of, and then and a tax saver fund.
We'll take Akshita's question, and she says that she wants to start investing in mutual funds and she can invest 5 to 10,000 per month. The goal is to save as much as possible for long term, and here she means 10 to 15 years. She wants you to recommend some funds, and the average return that she's expecting is 12 to 15% per year. So that's not a wrong expectation to have, but we don't have her on the phone line. 5 to 10,000. How many funds ideally one should be having?
2 funds at max is more than sufficient to start off. And if she's as she rightly mentioned that she's an absolute beginner, so she can start with an index fund, maybe Nifty 50 index fund, and she can have a flexi cap fund to start off. Once she gains some experience of the volatility of the market, then probably she can move towards small cap funds and add those funds also in her portfolio. If we talk about flexi cap fund, presently I am personally studying and liking DSP flexi cap fund, and even Kotak flexi cap fund is good, although it has it is too big in size now, but still you can study these 2 funds to start off. See, whenever we are starting, I think we should start slow and look out for defensive funds, and eventually once we learn how market volatility work, how market work, then slowly and gradually we can keep on adding some aggressive fund and make our portfolio accordingly.
All right. With 5 to 10,000 per month investment for 10 to 15 years, how much she'll be able to accumulate? Obviously, I mean, if there has to be a goal which needs to be defined in terms of corpus that she wants to collect, but approximately what will be the corpus that she can accumulate?
See, if she is investing 5,000 at 12% expected rate of return for 15 years, then somewhere around 25 lakh of corpus can be accumulated. And if she is investing 10,000, roughly 50 lakh of corpus can be accumulated. I have taken assumption of 12% of expected rate of return on a comfortable, decent side.
Right, we move on to Shalab's question now, and Shalab wants to invest 15,000 per month in mutual funds, has a medium risk appetite, and time horizon is 15 years. Goal is to have 5 crore corpus within that time frame, and also wants to know the ideal SIP amount for this particular goal to achieve the target. Yeah.
See, firstly, there's a very interesting rule of 15, 15, 15. I think that is why he's investing for 15 years, 15,000 rupees per month. And rule says that if you invest 15,000 rupees per month for 15 years at 15% expected rate of return, you will be able to reach a corpus of 1 crore in 15 years. That is the formula, which is quite famous of lately on Instagram Reels. So I think that is why he has chosen this 15% and 15,000 in 15 years figures. If we talk about logically and conservatively, at 12% expected rate of return, he will be able to reach a corpus of 75 lakh. If we want to reach a corpus of 5 crore at 12% expected rate of return, he need to invest at least 1 lakh rupees per month, or else he will need 30 years with 15,000 rupees investment to reach his goal.
All right, we move on and we'll take Anand's question. Anand is investing 12 to 15,000 in SIP every month and is holding Nippon India Large Cap, SBI Magnum Mid Cap, also Parag Parikh Flexi Cap, and the target is to accumulate 5 crores in 10 to 15 years. He wants to know that the SIP amount is enough to achieve this target and if the funds are right for him.
Almost same calculation which we just discussed. 1 lakh SIP is needed if you want to reach a corpus of 5 crore. I think of lately 5 crore is a fancy figure and everyone want to achieve it. And I'm very happy that at least people are having higher aspirations to reach a bigger goal. And it's absolutely okay. But we need to make sure that we are doing our maths right. We need at least 1 lakh rupees of SIP if we want to reach that goal in 15 years, or else we will at least need 30 years with the same corpus. If we talk about funds, is Parag Parikh Flexi Cap Fund. This is a fund which is too fancy of lately. And I am personally a bit defensive on this fund. And instead of this fund, I feel that better Flexi Cap Fund going forward can be there. It's a good fund and it has performed really well. But going forward, because corpus of this fund has increased a lot, I am a bit conservative and I am just keeping a watch on this fund before investing anything further. So that is my personal view. Otherwise, instead of Nippon India Large Cap Fund, I think Index, as we discussed already, can do our job. SBI Mid Cap Fund is absolutely okay and can be continued in our portfolio.
So, Anand, what's the larger AUM got to do with the fund performance?
Once AUM is above 15,000 crores, I feel it is really difficult for a fund manager to take an aggressive bet, especially in small cap space, because suppose there is a very small cap company which a fund manager is liking. And if that fund manager is looking to invest just 1% of his total portfolio in that stock, just because that particular fund manager is investing in a very small cap stock, suddenly we'll see a lot of volume and the impact cost will be very high for that fund manager because of the low volumes which is usually there in small caps. So I feel then of lately, we have seen that whenever fund rises above 15,000 crores, major portfolio is by default allocated in large cap because of this cost or this risk which is there of investing in small cap. Also, there is this supposedly if I have.
But Parag Parikh Flexi Cap so far is a very large cap biased Flexi Cap. But then yeah, we get your point. Thank you so much, Anand, for being on the show, and the time is up. Thank you for helping our viewers with their financial portfolio today.
Thank you so much.
We move on. We at the Times Network are back with our flagship event, India Economic Conclave, which is known to set the stage for driving India's economic agenda as we move forward on the path of integrated, equitable development, which is all-inclusive, all-pervasive, universal, and one that strengthens not just the Indian economy, but the global one as well. To pursue this agenda, the theme for this year is India, the emerging third superpower. IEC will feature the biggest voices from politics, the global markets, economy, and corporate world. So get ready to catch all the action here on Times Network.